What's going on, guys? In this video, I'm going to be sharing with you exactly what an earnest money deposit is and how you can get your earnest money back if a real estate deal goes sideways. If you're new here to the channel, my name is James Holloway and I'm primarily a real estate investor. And my mission here on YouTube, well, that's to help you achieve your financial freedom through real estate investing and other money-making strategies. So if those things sound good to you, consider subscribing and turn on bell notification. You just click the little bell icon and you get notified every single time I upload a new YouTube video. Let's define what an earnest money deposit is. It's also known as an EM check, which stands for earnest money check, earnest money, or EMD, which stands for earnest money deposit. An earnest money deposit, that's money that you have to fork up whenever you're buying a house to let the seller know that you're serious about buying their property. Typically, it's 1% of whatever the purchase price of the property is. So if you're buying a $100,000 property, you're going to be putting 1% or $1,000 down as an earnest money deposit. This typically has to be done within 3 days of your contract getting accepted. By doing this, it shows the seller that you're serious, because if you back out for a non-valid reason, that seller can keep your earnest money. Later on in this video, I'll be showing you some valid reasons to back out in a little bit in this video, so stick around. So where does this money go? This money doesn't go directly to the seller. It goes to an intermediary, and they hold the money until the funds need to be distributed. And that's someone who holds on to that money. It's an escrow company. Basically, the title company or the escrow company that you are going through to buy that property, that's where the money is going to be held. The earnest money typically goes towards the purchase of the property. So if you're buying a $100,000 property, you have to put $1,000 down as an earnest money deposit. That $1,000 goes towards the $100,000 purchase price. So whenever you go to get a loan, it's going to be $99,000 instead of $100,000. You might be thinking to yourself, I don't have enough money for the earnest money deposit and a down payment. You need to contact your bank that you are going through for the lending and ask them and talk to them. Be like, hey, can I use my earnest money as part of my down payment? The worst they can say is no, but it's worth a shot, because I know for a lot of people that money is hard to come by, especially if you're utilizing a 3.5% to 5% down loan program like an FHA loan. You're looking for a low down payment. So if you're living in somewhere like I'm living, where the average home price is $300,000, that's 1% on top of the 3.5% to 5% down you have to pay. You need to contact your bank before you put the money in the escrow company, because once it goes to the escrow company, it's going to be really hard to get back if your bank says no and you don't have the funds to complete the transaction. And if you're already getting value out of this video, hit that like button, turn it blue so the YouTube gods know that there's value in this video and other people need to know this information. Now, how do you get your earnest money deposit back if you want to back out of this deal? Well, whenever you're putting in your offer for the property, there's two contingencies I want you to have inside the contract before you even send it to the seller to accept. One is a financing contingency, and the second is a home inspection contingency. Before I dive into these things, there's some key things that you want to know about these two contingencies. While these two things are typical to have inside of a contract, just know that whenever you have these contingencies in place, that your offer is going to hold less than someone that waives their right to a home inspection or financing contingencies. Why? That's because if you have these contingencies, basically you're telling the seller like, hey, if I don't like what I see inside the property, your home inspection, or I can't get financing, I'm going to back out of the deal. So if the seller has two offers and yours has these two contingencies and the other offer has one contingency and that's the only difference, they're probably going to go with the one that has one contingency, because they don't want to deal with the headache of, you backing out of the deal, having to put it back on the market, get accepted again, maybe having to go through this whole process another time. But in all honesty, I don't recommend you waive your right to these contingencies. I'd rather you have them in place and not get your offer accepted than, your offer get accepted without contingencies and then you have to back out of the deal. Then you're going to find yourself in a really sticky situation. So I typically always put in these contingencies unless I know this deal is going to be a home run, even, if I don't like what I see in the property. Okay, like I touched on already, a financing contingency is basically meaning, you can't deliver on the financing. Meaning whenever you get a property under contract, the bank is going to go deeper inside your personal records, your finances, like if you can actually afford this property. And if they determine that you can't afford this property, they'll shut you down and be like, you know what? we can't give you this financing. And that's where your financing contingency comes in, because if you can't get financing, you can't get financing. And if you can't, this is a way to recoup your earnest money deposit without facing any repercussions. Now, a home inspection contingency. This is the point where you're going to hire a home inspector, and they're going to go inside your property and give you a full breakdown of what's going on inside the property. So if there's a leaky faucet, they're going to tell you. If there's a light switch that doesn't work, they're going to tell you any little minor details and the major details. If your HVAC isn't working, if the roof needs to be repaired. This is why you need to have a home contingency in place, because, if you find these things, if you find out that the HVAC isn't working, there's a hole in the roof that you didn't see, you can ask the seller, be like, hey, can you repair this before I buy it? If they say no, you're out. Like, that's how easy it can be. And more importantly, if you just don't like the inside of the property anymore, you can just back out. Be like, you know what? I didn't like what the home inspection was telling me. I'm sorry. I need to get out. This is why I always suggest you putting your contingencies inside the contracts, because all it is reducing your risk. If you know your deal is a home run and you don't mind that risk, then go for it. But that's more likely for the experienced real estate investor. If you want to know more about buying real estate with literally none of your own money, there's a video popping up right now, right here. I hope this video was value packed for you, because that's all I'm here to do, is provide value to you guys. Until next video, guys, I'm out. See ya.